Year to date, the market is starting to look fairly strong. We're seeing more and more companies into the green and at a fairly healthy percentage. However, that doesn't apply to one of the worst performing stocks in the market, if not the worst, which is UnitedHealth Group. They're down 40%. That is just in a matter of months, where we do actually see others in the industry like CVS up 43%, ELV up 4, CI up 14. It does make them the worst performing, not just in their sector, but as we said, also likely the worst in the market overall. So we want to understand, for a company that is down significantly year to date, down 39% over the last year, is this one we should consider adding, as it does sit near the 52-week low? We also can flag that both Seeking Alpha as well as Wall Street do consider this company a buy, and we're going to give you our thoughts not just about the valuation but also about the quality and if this is one we would consider. It's also very interesting to note that in just a matter of weeks, many analysts have started to cut their price target. We have Wolf Research, they've lowered it down to $390. However, they do believe the company will outperform the market. Again, another analyst, Troyes, who do lower it to $360, but they still also maintain this is one for serious consideration. We have maybe one of the largest drops, that is by HSBC, who actually believe this is one to definitely avoid. They see this at $270, but there are also others like KeyBank who have lowered their price target, who still see some massive upside. And whilst many analysts are lowering their price target, we have JP Morgan who still believe this company is one that will outperform and have a $405 price target. Now, if you missed it, the reason why we have seen such a significant jump, many news has come out that has put them in a very bad light. We had just last month the CEO leave very abruptly for what they said was personal reasons, where they did cut their full forecast for the year. We then saw allegedly from the Wall Street Journal that they were under criminal investigation for fraud in relation to their Medicare. We have another news point here that said they secretly paid nursing homes to reduce hospital transfers. And if you thought that was a lot already, well, then we had another article that came out and said they were pressuring medical staff to change patient status to do not resuscitate. Again, more and more bad news that probably does make it understandable why we've seen such a massive drop in the share price. But nonetheless, if you have been a longer term investor, you would have still marginally outperformed the S&P. Over the last 10 years, UNH up 190%, the S&P in comparison up but only marginally less at 185. And you can see that this does look like a company purely based on valuation that looks severely undervalued. We're talking a forward P of 13 when their 5-year average sits at 20. This is pretty much one of the lowest valuations they've offered to shareholders in the last 5 years, whilst also offering one of the highest yields at a near 3% rate when their own 5-year comes at 1.42. So these are all flashing signals that the company looks to be at a very attractive price if you do believe in the longevity of the company. And that's also reflected when we take a look at the blue tunnel methodology, which highlights the intrinsic price. Now, we would say we typically like this to increase over time, as you naturally would want. However, we are seeing it decrease, meaning the share price is intrinsically worth less and less. But nonetheless, the key point is still disparity between where the company sits and even the bottom end of the blue tunnel, something we have seen over the last few months, indicating at least in the shorter term and the majority of 2025, UnitedHealth does look severely undervalued. Now, if we were to expand this to over the last 5 years, you can actually see this isn't a company that typically does trend in undervaluation territory. We even get quite a long stint from 2020 to around 2023 where this company was trading in severe overvaluation before we note trading in some patches of severe undervaluation. Right now though, disparity is at its peak, meaning on this metric alone, definitely one to consider. And even on a valuation grading, whilst they do get a C+ overall, on a forward P where they sit at 13, they are trading lower than the sector at 18, meaning you're getting a 26% discount, as well against their own 5-year, a 36% discount. Overall though, conclusion pretty much remains the same no matter what metric you look at. The company UNH is trading at a large discount to both 5-year and the sector. our responsibility is to understand, 1, does it deserve the discount, and 2, what is the intrinsic price, so we can come to our own buy price signal. Now, as we've highlighted many times on the channel, right across the S&P, companies are trading in the red, meaning valuation alone, they look to be very costly, very overvalued, but this isn't something we're seeing from UNH. As we do know, it is sitting in the green, but this actually highlights something else that is very interesting. The industry as a whole is looking undervalued, so not only UNH, ELV, CVS, even after the great run it's had this year, CI, MOH, CNC, looking like potential buys. However, the key thing here, as we're dedicating the video to UNH, it does look like severe undervaluation is continually being confirmed. Now, they do lack in their growth at an F, but still year-on-year revenue 8%, forward-looking 9%, which is marginally above the sector. So what this highlights to us is that yes, the company trades at a discount to the sector, but should they really be trading at that level when they're growing their revenue faster? Granted, they're growing it a little bit slower than what we have seen over the last 5 years. Earnings per share is probably where the company does lack overall, projected 7% moving forwards when the sector sits higher at 10.6 and so does their average at 13.3. But if we look over the last 10 years, they haven't had a massive problem with their top line growth. We're seeing nearly double digit every single year, 8% in 2024 and the 3 previous years around the 12 to 15% level. So this is still a company that when you compare it to others in the industry, it is growing at one of the fastest rates. That does make it attractive. The earnings per share, however, projected does let it down. And if we look at their most recent earnings, their top line revenue is up 10% year on year. They're generating some significant levels of over 100 billion. And whilst we see no efficiencies to their operating margin at 0, we notice their bottom line up 7 percentage points year on year. Very good, very positive signs. And we also like the fact that the large bulk of their revenue, which comes from premiums, is up 11% year on year. Now, we have to flag that over the next 4 quarters, they're only projecting one of them to be growth, 3 of them the decline, in fact the next 3, whilst also having a 75% track record, 3 out of 4 beats, most recent quarter a 9-cent miss, trading on 2026 numbers based on the EPS of $26 at a forward P of 11.5. Yes, it's great to consider companies that are performing very strongly, but companies like UNH, if you want value and you believe in them in the longer term, could really offer some great potential. Now, we also have to flag that just days ago they increased the dividend 5.2%. Yes, it's above the inflationary target that we have of 4%, but when we look at over the last 5 years and the last 10 years, we are quite disappointed as we have seen 19% increases to the dividend over the last 10 years, year on year. They're also a company that has been increasing those dividends over the last 15 years consecutively, and important to understand that their dividend safety score does sit at 80 safe. Only reason we're flagging this today is because it was downgraded not that long ago, but nonetheless the message does still remain: a dividend cut for this company is unlikely. Now, one of the main things we look at when we want to see if a company is potentially showing signs of an upcoming dividend cut is the free cash flow payout, where we want to see below 60 for the majority of companies. We see that every single year. We're talking around the 30% or even lower on average, and on a trailing 12 month 31% expected that over the next year, so no real worries from our view, and 80 is still a safe score. It is also a company with phenomenal free cash flow which increases consistently over the longer term. Granted, we see a drop into 2024, it is still projected to increase over the next 12 months to $28.10, and they also have a very good consistent ROIC where we want to see 10% or more to give us faith management are able to effectively allocate their capital. Very consistent, sitting at 14% on a trailing 12-month basis, and even their net debt to EBITDA, which does also correlate to dividend safety, but as well as that, balance sheet strength, looking very strong, below the 3 that we want to see at a maximum for companies generally. And the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.2 on a trailing 12 month, little increase projected over the next year, still highlighting the strength of this company and no red flag indicators. We will also say it is one institutions love with their 88% ownership. Granted, they sold 36 billion over the last year, they bought a lot more at 56 billion, and in fact in the most recent quarter they bought more than twice as much than they sold. 19 billion buys, 9 million selling, so clear and obvious institutions still very bullish on UNH. And it's not just institutions who are bullish. When we look at insiders at 0.33% ownership, yes, they sold 2.5 million over the last year, but they've bought 32 million. That is more buying than selling. Something interestingly is very rare to note, and in the most recent quarter we see 32 million worth of buys. Now remember, this is a very bullish signal as management buy because they believe the share price will go up, and we can see the buys very recently as well. 15th of May, where we get the chief financial officer buying 17,000 shares, costing them around $5 million, and we get the CEO on the same date as well, buying under 87,000 shares, and that cost them around $25 million. Now, it isn't just from these insiders that we're seeing buys. We also notice Congress member Marjorie Taylor Greene also adding on the same date, so whether you want to incorporate that in your analysis or not, all right now are pointing signs that institutions, insiders, and members of Congress are bullish on the company. We'll also flag their margins where they do get an A+. Gross sits at around 22%, which is below the sector at 60% and also below their 5-year. Not a great sign to see, but what is positive is their net income margin at 5.4% is well above the sector, which is actually burning through cash, -2%, and pretty much in line with their historicals. And if we were to draw your attention to the cash from operations, still they continue to generate more and more at 29 billion when their average sits at 24.6, and as we mentioned above, the sector actually burning through cash. So you could have some argument to say that the market is overreacting. They're valuing this company, in fact, at a discount to the sector when the majority of metrics that we have just run through are in fact showing the opposite. So a quick recap before we get into the valuation. We get a double buy from Seeking Alpha and Wall Street, a C+ on valuation, F on growth, and an A+ on profitability. Now we also want to let you know we have released our latest free weekly article. We draw on every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as a recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P. So click below, sign up, and you can read straight away. Now our intrinsic value gets to $410 today, which is purely the average of these four models that you see on screen. We can talk about the inputs and the outputs, starting off with Graham's valuation. We have the EPS, their long-term growth rate, and the AAA corporate bond yield, giving us our first intrinsic price showing marginal overvaluation, $287, market price currently around $302. Remember though, we're not looking at any one of these in pure isolation. We then have the multiples, companies similar sector and size, average P multiplied by the EPS of UNH, giving us another marginal overvaluation signal, before moving into the third model where we have the dividend discount, the most recent increase as well, on average 12%. We did still want to be conservative at 6%, giving us our first undervaluation signal. Then we move on to the DCF model with the free cash flow year on year, average growth 14%. We've gone 6% lower as well than analysts to be more conservative, and with the discount rate we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and actually a second undervaluation signal, meaning 2 overvalued, 2 undervalued, coming to 409. Now with the price at 302, we are still getting an MOS where we use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at $386, then we keep going till it's near the current trading price, and in essence, we're saying around 307, you're getting a 25% margin of safety. At 30, around 287, not quite there yet, so leaning more towards a 25% MOS. Wall Street, they see 26% upside over the next year, projected target $380. Give us your thoughts. Is this, in your opinion, a buy, hold, or sell? We're looking at 25% MOS, 26% upside. Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.